Hello and welcome to a fresh new edition of Bazaar Morning Call. It's a Thursday morning. I'm Prashant. With me, my colleagues Nigel and Reema. Guys, hi. Good morning. I mean, it's one of those sessions where I guess we just have to wait and watch because the big data point is ahead of us and not behind. I mean, it's almost similar to last Friday's session. We were all waiting for that jobs number, and it did turn things quite a bit. It did move things around quite a bit. So this is one of those once again. Global markets are also quite ahead of that CPI number. Oil prices have cooled off. I mean, oil prices were knocking at almost three-digit levels, and they've pulled back from 98.5 to 92, closer to 92 now. That's a big positive. That's the biggest positive for India. It's also the biggest worry when it moves higher. Big moves in global forex markets. I mean, you know, what's happening with the pound, what's happening with the yen, which is now at a new 24-year low. So, I mean, it's all happening here. But I think for India, the big one are oil and, of course, later what happens with that inflation report out of the US, which may clarify next moves in the market. Guys, hi, good morning.
Hi, and did you know the biggest US market days so far this year have been either on the CPI days or on the Fed outcome days. So this is going to clearly be a big one. But we had our own CPI, inflation data, which came out yesterday. The inflation print for the month of September came in line with expectations at 7.4%. But remember, the RBI will be monitoring one more inflation print that's going to come out in October before it heads into its policy meeting in December. So inflation in the US, inflation in here. So you're going to hear a lot about that word, Nigel.
Well, that's right, Reema. But Prashant has been tracking the cues. Prashant, clearly we have a big queue that's coming up. Yeah. Overnight, I mean, there are still some headwinds. But as you pointed out, crude oil prices cooling off, a bit of a positive.
It's a big positive, Nigel, right? I mean, it trumps what happens to the dollar, what happens to global markets, because we import 80% of the stuff, right? Absolutely. It's not in our control. And when it moves lower, I mean, I think that is a big relief. Now, let me just quickly set this up. So all eyes, of course, on the US inflation number, which comes in. Remember, going into the inflation print, we've got the jobs number, which has been the unemployment, the underemployment numbers, etc., which have been stronger than expected, which means Fed stays higher for longer. We got the producer price index number yesterday, which again, the core number, ex-energy, food, trade, that is also hotter, which means that higher for longer. And then we finally come to this, the CPI number. Now, core CPI is what you want to watch out for. And I would say, all of the economists, if you read, they're all saying that we are expecting the actual number to be higher than our own forecast. So, I mean, it's a little bit of a ironical kind of situation. But Morgan is saying that, Citi is saying that, most brokers, global economists are saying we expect what the number will be to be hotter than what we are expecting. So I think markets are in a way prepared for that this is going to be an ugly number, this is going to be a bad number, which means the risk is on the downside. If the core CPI is below a consensus or even at consensus, which is about 0.4% growth month on month, it can lead to a temporary relief rally. It could be an aggressive move as well, depending on what Fed speakers react and say post the CPI number, because we've got a slew of Fed speakers also lined up, and most likely they'll react to the inflation number. So it could be an important one. I would say, given the positioning, if it's hotter than expected, it's sure markets can sell off. But US markets have been falling non-stop in any case. So risk-reward wise, I think the risk is perhaps to the downside. It's very unlike the situation in terms of the last jobs number. US markets had a bit of a relief rally, and you went into the jobs number in a slightly stronger fashion. Not this time around. So that's one thing. All right, Nifty here, just quickly coming back and circling back to where we are at. The Nifty has resistance around 17,260. This is nothing but three things. The 38% retracement of the fall from the September high to the September low. It's also the high yesterday. It's the high day before yesterday. So this is something you want to watch. And then you've got resistance at about 17,430, which is the next stop. Banks saw strong buying, and I mean, both private and PSU banks did well. The support there comes around 38,600. I mean, you're better off buying around these levels, but we'll see how markets open. If you get a dip at some point, I think that's a sort of sweet spot in that sense. Oil prices are down 6% in the last 4 trading sessions. And I think, from 98.6 down to back to 92, I think this gives us some cushion to deal with whatever comes our way from the US later in terms of the jobs number and market reaction, etc. This is working well so far. OPEC, for example, yesterday cut its forecast for demand growth and that also pushed prices slightly lower. At least something working in favor for global markets and, of course, big importers like ourselves. Najib, what are you watching out for?
Well, the headwinds persist. But the sense that I'm getting is the bulls, they are up for a fight. And the 16,800 to 16,900 level, if that is held up, unless things really go wrong, I think the bulls are counting on that level, particularly holding out. The Nifty Bank, though, moving above that 50 DMA and trading above that, that's the key for the bulls. So those are the three big points that I want to put out. And the reasoning comes up for you. Institutions, yesterday they were net sellers to the tune of around 450 crores. The FI net sell number was around 500, 550 crores. The bulls will say, well, we can take that 500, 600 crores of a net sell number. What are the FIs doing in the FNO market? Though in a live market, you had the Nifty open interest that was low and the Nifty went up. First signs of short covering on the Nifty. The Nifty Bank, that's been the rock. That continues to see fresh long build up. And just take a look at the FI data. On the long side, yesterday, we had close to around 9,000 contracts on a base of around 25,000 contracts. So that told you that the long open interest went up by close to around 35% odd. And there was some mild short covering as well, though they continue to remain net short on the index, with close to around 81% of their positions on the short side. They bought puts in case things go wrong. There is some protection out there. But the biggest positive for me is that they wrote 60,000 puts, telling you that they're trying to make some sort of a base at lower levels. And the crucial support number comes in at around the 16,950 odd mark. A few reasons for that. 17,000 put saw a fair bit of open interest. The premium was around 50 rupees. So that's why 16,950 is important. A couple of other reasons in the last few days, well, we bounced off those levels. 16,950, 16,960 odd. So the broad range for the Nifty, the 20 DMA on the upside, if you can get past the 17,300 mark, you'll see a big bout of short covering. But on the downside, the 200 DMA, well, that appears to be a line in the sand. Resistance at around 17,300 to around 17,350. But the Nifty Bank, that's been the go-to index. And that, in fact, has support at around 38,500, 38,600. From there, we have seen big bounces. So I'm counting on that level holding out. But the real clincher for the bulls will come if the Nifty Bank can move above the 50 DMA. So the Nifty moves above 20 DMA, the Nifty Bank moves around the 50 DMA, then we could be off to the races. For starters, not such a bad thing that the SGX Nifty is indicating a bit of a pullback. I think at lower levels, if you could buy around 17,000, maybe you get a bit of a bounce considering the FIs are so net short on the index. Yeah, Prashant.
I just want to say one thing. If you're trading, right, it makes sense to be quiet and sit on your hands, at least today, because the fact is things are oversold, and you pointed that out as well. Yeah. And data also indicates that. But sometimes, the point is when markets are oversold, this oversold business works or overbought business works in normal market conditions. Sometimes, oversold becomes more oversold, especially with all that is happening globally, right? If something breaks, we've seen what's happening in UK, we've seen what's happening in other. The Swiss National Bank, for example, has got a swap line for dollars with the US. It's got to. And that's a safe haven kind of zone, right? So if something breaks, it's possible things slide more. So, you may get it right if you go long and things reverse. But the point is, the first rule is to protect capital and not lose money. Yeah. So I would say, going into this one, at least, as markets close and then, intraday, of course, is another matter. But point is, into close, you want to go in light with the inflation number, which is, of course, due when U.S. markets start to trade. That's a limited point.
It's a little tricky, actually, Prashant. Just one quick point. They wrote puts big time, and today's expiry as well. So you have a big data point coming up post-market hours, and also you have expiry. So things are going to get very, very volatile. Yeah, Rima.
Okay, but so far we've been respecting that range, and you go in, if you don't go in light and you take a position and it goes against you, you're going to be saying, why the hell did I just do that, But anyway, we're going to be talking a lot about IT as well, because yesterday post-market hours we got numbers from Wipro as well as HCL Tech, and no clear direction coming through. So in that context, Infy's numbers today are going to be important. HCL Tech has made a very strong comeback. Q2 numbers, a beat on all counts. They've gone ahead and upped the revenue guidance for this year. So despite all that talk about macro uncertainty, volatility, slowdown in demand, HCL Tech has gone ahead and raised the revenue growth outlook for this year, and valuations for HCL Tech are also fairly reasonable in the large cap pack. But Wipro, on the other hand, sounded very cautious. Even its guidance for the next quarter, that's the December quarter, and that's the only one which will give you a near-term outlook. They're just guiding for 0.5 to a 2% growth, much lower than consensus expectations. And even, when you heard into the conference call from the management, I chatted with the management in an interview, they sounded cautious on the consulting business. And in a way, This guidance bakes in the changing market reality. In theory, Delaporte's own words, the market today is vastly different from what it was a year ago. Analysts too have lowered the EPS estimates post this miss in Q2. The stock, remember, went up just towards the last hour of trade. It did see some buying. It was up close to about 1% by the close of trade. So let's see if a little bit gets shaved off today. But that's the picture on IT. Infi will be reporting numbers today. But let's get you some equity market calls then. Sanjeev Prasad of Kotak Institutional Equities says it may be prudent to assume higher cost of capital in the future, given the possible reversal in 4 of the major drivers of equity in the past 30 years. 1, global peace. 2, low global interest rates. 3, rise of China. And 4, zero or low cost of environmental damage. He says we now see a greater geopolitical risk versus peaceful coexistence since the 1990s, higher interest rates as opposed to the steady decline in interest rates from the late 1980s, lower benefits of maturing Chinese economy, and higher environment-related costs due to climate change concerns.
Some money market views as well. This is Parul Mithil Sinha, Standard Chartered Bank, who says the dollar INR rose above the $82 per dollar mark last week on broad dollar strength amid weak risk sentiment and rise in oil prices and OPEC supply cuts. She says forex losses were capped by US dollar sales by PSU banks across spot and forwards. She expects the dollar INR pair to move in a range of between 82.10 to 82.5 next week, with a firm focus on trends in global risk assets. She adds markets are also watching for any announcement of steps by the RBI to raise US dollars to address forex pressures.
On the bonds, Parul Mithil Sinha of Standard Chartered Bank says domestic bond yields rose last week, tracking the sharp up move in global rates. The inline September CPI data may be a non-market moving event as inflation risks need a close watch. She expects the 10-year bond yield to trade in a range of 7.4 to 7.6% range, with the US CPI data in focus. An upside surprise may drive further increase in global rates. Domestic rates are likely to continue to be driven by global bond market developments, inflation trends, and any cues on central bank pivots.
Well, we have a lot of stock-specific action to track today, and we'll get to that in just a bit in our top 10 segment. We'll be looking at HCL Tech, IOC, BPCL, HPCL, Nalco, Vedanta, and Hindalco. They are the stocks that are on our radar on the back of positive news flow. And we have Wipro, Adani Wilmar, Sterling and Wilson. Well, they are stocks that are likely to open up in the red.
Steve Brice is Chief Investment Officer at Standard Chartered. He's joining us right now to take some questions. Steve, great to have you back on the program. Thanks very much. How important is the CPI number later today, and will that spark a big move across assets, in your opinion?
Well, actually, I agree with your comments earlier, right? I think markets are pretty set up for a poor outcome here. Obviously, we've had the FOMC minutes and some speaker comments as well, sort of alluding to the hawkish stance that we have there. There was a little bit of a hint of maybe calibrating the pace of rate hikes at some indefinite point in the future, but for now, the focus is definitely on a 75 basis point rise. But if you look at the VIX index, we're at the highs for the year. And from that perspective, this is an important number to see. If even if it doesn't, surprise on the positive side, i.e. fall significantly, then I think markets might take temporary relief from the numbers.
Hi, Steve. Morning. The Fed minutes we got yesterday, and as you said, they sounded more hawkish than dovish. But that one point gave the market participants some hope that maybe we could see some bit of easing on the interest rate, or maybe a bit of a pause. How many rate hikes are you factoring in before the Fed takes its foot off the pedal from year on? Is it maybe for this year or the next 6 months or so?
Yeah, I mean, it's been really difficult all year, right, to try and predict where the Fed's going to be. I mean, we were talking at the end of last year, the Fed was talking about 75 basis points for the full year, and it's done 3 of those in consecutive meetings, and likely to do the 4th, right? So I think that's the most likely outcome, is that we see another 75 basis points in the early November meeting. We may then start seeing them ratchet down the pace of tightening, but still tightening. Inflation is going to remain elevated for quite some time. And absent a financial shock, and we've seen a couple, obviously, in recent times, obviously the UK in particular, we think they're going to still continue to hike rates despite slowing growth expectations. So from an equity market perspective, I guess we sort of talked about the very short term, but we're looking at 1 to 3 months, despite pretty bearish sentiment out there. and people being underweight equities, we still think there's risk of continued volatility into the year end before we form a base potentially in 2023.
Steve, morning. We've seen some extraordinary drama as well as commentary and moves coming out of Bank of England over the last couple of days. And markets are clearly very jittery about the developments, the flip-flop, the different noises and sound bites that we're getting in from Bank of England. What are the implications for the global economy? Can it trigger a big round of volatility? Can it force the hand of other central bankers? How should investors in India watch the developments unfolding there?
To be honest, I think the knock-on implications for the global economy are going to be pretty limited. Obviously, the UK is still a relatively small economy from a global perspective. Not insignificant, of course, but it's not a US or a China or a Euro area. So from that perspective, it's probably entertaining to watch to see what's going on. I think the good thing, of course, is obviously the Bank of England wants to stop the emergency measures by tomorrow. But it's obviously watching things very closely. So should it need to reverse course, I don't think they have a major issue of doing so. But I think they're just trying to put a lot of pressure on the pension funds, etc., to clean up what they need to clean up as quickly as possible, so then they can move back to what they really want to focus on, which is managing inflation. So from that perspective, obviously, yeah, you're right. We're seeing very, very high rates volatility in the UK. We probably at or past peak rate volatility now, but that doesn't mean interest rates are coming down. We still see bond yields remaining elevated, and obviously the Bank of England returning to tightening policy. So sterling could still test parity. We've seen obviously sterling bounce significantly from the lows post the mini budget. Everybody uses quotation marks around mini, of course. But we could see a further weakness in sterling in the short term, testing parity before again that probably bottoms out and moves higher in 2023.
Steve, some have pointed out the risk of a financial accident into the end of the year, some sort. What shape, form, no one knows, right? So, I mean, is that on your radar? Most analysts put that as a footnote. Well, all our forecasts don't work if there is a financial accident of some sort. I just leave it there, just in case. What's your sense?
Well, yeah, I'm an economist by training. Obviously, I've moved on from that from a professional perspective, but we always make assumptions, right? So, look, I think it has to be on everybody's radar, right? I think the first thing I'd say is that we are most likely to see a policy mistake here, right? So we have a 75% probability of a recession in the US over the coming 12 months. So that's our view in the CIO office. So even absent a financial shock, that's obviously not a great outcome or a great environment. The thing that makes us probably a little bit more concerned about whether that will be deep or maybe more lead to financial fragilities is just the pace of tightening. We've never seen anything, certainly not in my lifetime, something like this before. And it does risk uncovering things that we're not aware of, right? And we've seen that in the UK. We've seen that in the European financial sector to some extent, although fairly idiosyncratic at this stage. But it obviously is something that you have to be keeping an eye on. The reality is it's an unknown exactly what it could be. So we're just keeping an eye on it. But yes, when it's an unknown, it's difficult to quantify, and therefore it becomes that asterisk footnote that you're talking about.
Steve, very quickly, you were bullish on India, though equity is globally will remain volatile. You continue to hold that stance?
Yeah, so we're overweight India within Asia ex Japan. So that's still our stance. Obviously, we're not hugely bullish on oil prices from here, so that's a positive factor. I know we had the inflation print today, but we do think inflation is going to come down, so that should lead India to outperform.
Okay, all right, Steve. Thanks so much for stopping by and filling us in with your quick take. And good to hear that you believe crude oil prices have peaked up and, in fact, continue to remain bullish on India. For the time being, we'll slip into a short break. You come back, we'll get stock specific. We'll focus on the top stocks for the day. Welcome back. The SGX Nifty suggesting a 65-point downtick, but there'll be plenty of stocks to focus on. And our research team is joining in to run us through that entire list. CNBC's top list of stocks for the day. But Rima, you go first. You're tracking the two IT numbers that came last night. HCL Tech and Wipro. How were they?
HCL Tech strong, Wipro soft. That's the one-word summary of the numbers. But let's talk about, let's delve into the actual numbers. So for HCL Tech, constant currency revenue growth at 3.8%, in line with consensus expectations. Margin expand by 100 basis points ahead of what market was projecting. Deal wins have gone up by 16% on a quarter-on-quarter basis. So this is an all-round beat from HCL Tech. But the positive surprise was that the company went ahead and raised the full-year revenue forecast. Earlier, they were expecting a 12 to 14% growth. Now they're expecting 13.5 to 14.5. So this will provide a lot of confidence. And remember, HCL Tech anyway trades at relatively lower valuation. The margin guidance got tightened to 18 to 19%. But that doesn't come as a big surprise. Talking about Wipro, where the ADR, by the way, was down about 1.5% in the US yesterday. Q2 was in line with expectations, as the numbers on your screen tell you. But the miss was on the Q3 guidance, which was modest. They're just penciling in a 0.5 to 2% growth, and that has disappointed the street. Brokerages like Nomura, CLSA have all lowered their EPS estimates on the back of Wipro's, okay performance in Q2 and the modest, softer than expected Q3 guidance.
Good thing is that both are the cheapest, right?
Yes.
IT services.
About
I think
15.5, 16 times forward multiple.
So, I mean, that comfort is there, and numbers, as Rima pointed out, of course. Well, oil marketing companies should be in focus. Sonal is here to tell us why. Sonal, hi.
Good morning, Prashant. Well, yes, they'll be in focus. The stocks did well yesterday in trade as well. And we got to know that the cabinet has approved 22,000 crore rupees as one-time grant to PSU OMCs in order to cover for the losses that they had been incurring in their domestic LPG segment. Sources are suggesting that they asked for 28,000 crore rupees, but the government went ahead and gave them 22,000 crore rupees for this. There were higher working capital debt for these companies because of this, and this could be taken care of now. So there could be some more relief rally in these particular stocks. But important to note that oil marketing companies are still making losses in their fuel retail segment. On petrol, they are making gains. On diesel, they are making losses. So net, there is a loss that these companies are making. Systematic said that they were making loss of around 280 crore rupees on fuel sales. So this is something that we need to watch out for. The crude prices above $90 per barrel, they have cooled off. But that is another thing that could be hurting their GRMs as well. But yes, the LPG part, that is a good news for these companies.
Okay, all right. Thanks a lot for that, Sonal. Well, let's focus on Vedanta. Well, the shareholders have approved shifting its cash from general reserves to retained earnings. Remember, the general reserves, as per the last reported number, was around 12,500 crores odd. The company's view earlier was that, the amount that was in general reserve was in excess of what the company anticipated with regard to the operational or business needs as well. So that's why they had proposed to shift this money from general reserve to retained earnings. You'll say, why do they do this? Well, first off, it's a book entry, just moving it from one header to the other. The key reason is it gives flexibility to use these reserves. Once it moves to retained earnings, then you can use it for paying out dividend. Remember, Vedanta has a net debt of close to 27,000 crores odd. But with this movement, well, now they are eligible to pay out dividend. And keep in mind, in September 2022, Vedanta Resources, they had come out with a note and they said that they'll be prepaying close to $900 million worth of bonds. So that's why the street said they'll have to do it via some move on this front, and that's precisely what's happened. So the street will hope for higher dividend, expect the stock to open up in the green. But Mangalam joining in to tell us about Adani Wilmar. Morning, Mangalam.
Good morning. So it's come up with its second quarter update as far as Adani Wilmar is concerned, and it does not look too good. In fact, the company says macro challenges continue to impact their business. Overall revenue for the business this time around is expected to grow in low single digit, and that's because of edible oil business, which while it witnessed higher volume growth on account of low prices, remember the prices of palm and soya bean have fallen anywhere between 40 to 50% and the company understandably has passed all of this to the consumers to maintain its market share, as a result of which the margins will be impacted this quarter as well. That's the mainstay of the company. But the growing businesses of the company, which is the food and FMCG business, that grew about 40% and they believe that this will only increase in its contribution. They have higher margins there as well. And industry essentials as well, a relatively more stable part of their business, grew by about 20% as well. But the largest part of their business is impacted by the big cuts that we've seen in oil prices, and as a result of which revenues would be muted.
All right, Mangalam, thanks very much for that. More stocks with news flow. Vivek has got that list. He's joining in. Vivek, hi, good morning.
Well, good morning. You know, the one stock that we are tracking today is Sterling and Wilson. Now, when you're talking about this particular company, came out with its Q2 results. It's been a subdued quarter as far as LW Solar is concerned, on the back of the fact that, ordering and tendering activity in the last couple of quarters has been quite muted. So when you're looking at the headline numbers, it seems quite a big dip, especially revenues are down almost 80% on a year-on-year basis. Revenues coming in at around 313 crore. The loss on the bottom line has come in as close to 300 crore versus a loss of 284 crore last time. Operationally, too, the company is in the red. But one thing, that may provide a little bit of support as far as this particular company is concerned is that they have said and confirmed that the NTPC order that was worth a little over 2,200 crore, the company has said that it has received this particular award confirmation, and this is for the building of a solar EPC contract as far as the Ran of Kutch, Gujarat is concerned.
Okay, all right, Vivek, thanks a lot for that. Well, just adding on to news for the aluminium stocks, we already highlighted about Vedanta, that's a company-specific issue. But for aluminium prices, that's LME prices, were up between 5 to around 7% overnight. That's after Reuters report suggested that the US is considering ban on Russian aluminium in response to the conflict with Ukraine. Now, remember, the big contributor out there is Rusal. They are the largest aluminium producer outside China. Rough number is they contribute close to around 4 million tons out of the around 65 to 70 million tons odd. So close to around 5 to around 6% of global supply comes in from Rusal. Since that is the case, we have seen a spike out there. So in the near term, it could keep aluminium prices elevated. Remember, this happened in 2018 as well, but those sanctions were lifted in 2019. So for the time being, you expect aluminium prices to remain higher, which will support Nalco. You have Vedanta and Hindalco, the India part of their business, not Novelis, but the India part of their business could get some support because it's directly linked to LME aluminium prices. Expect those stocks to do pretty well. Well, let's run you through the list of all the stocks that we just highlighted for you. Positive news flow, well, they include stocks like HCL Tech, IOC, BPCL, HPCL, Nalco, Vedanta, and Hindalco. While with stocks with negative news flow, well, they include Wipro, Adani Wilmar, and Sterling and Wilson.
Let's take stock of all the action from the commodity market overnight. Manisha Gupta joins in as always. Manisha, morning.
Morning, and thank you for that. Well, I'm looking at the crude oil prices where we have seen a fourth straight day of decline come in here. Last week was great. We saw 17% of a gain, but this week we've started on a weaker note. Well, with China looking at strong COVID measures yet again in major cities could dampen demand, and the markets also are reacting to the U.S. crude stockpiles, which have gained up by 7 million barrels. Markets also reacting to OPEC and the U.S. Energy Department demand outlook for this year and the next as well. The OPEC has cut demand outlook for the fourth straight month, and now they're expecting demand to gain up by just about 2.7% in this year and even lower at 2.5% in the next year. The U.S. Energy Department is looking at a lower demand growth in next year by just about 1.5%. So this is what the street really seems to be reacting to. In other news, the strength in U.S. dollar seems to be weighing onto the precious metal prices, and as Nigel was mentioning, barring aluminum, almost everything is still trading in the negative in Asian markets right now.
All right, so that's commodities. Manisha, thanks very much for that. Now, we've been focused on what the consumer price inflation numbers could be out of the US, but CPI inflation here in India has risen to a 5-month high of 7.4% in September from 7% in August. This is the 9th straight month of retail inflation breaching the RBI's target band. Meanwhile, India's factory output, IIP, contracted by 0.8% in the month of August. Lata is here with what she's making of both these data points. Lata, hi, morning.
Well, it was always expected September inflation would be high, but 7.4 is about 10 basis points higher than the 7.3, which most of the respondents told us in the poll. The painful part is food. Food is 8.6% higher and pummeled by two of the most important elements in our food thali. Cereals and veggies. Cereals up nearly 10%, and vegetables close to 20%. So these are going to be painful, though part of it was expected. The worry is that the long withdrawal of monsoon, which we are witnessing, could make October inflation also high. So on the street, economists are moving from an expectation of 35 basis hike in December towards 50%. There's a slight upward bias to expectations of rate hikes. Core inflation is also high, 6.1% compared to 5.9% in the previous month, but that is on expected lines. The 9th month of CPI being above 6% is important because the given mandate to the MPC is that it should be between 2 and 6% for 3 quarters in a row, if they don't keep to that mandate, they have to write a letter explaining it. This could be an added pressure on the MPC and RBI. So a slightly more hawkish stance in December can't be ruled out. But all these are pale in terms of comparison to what is happening outside in the world, what happens to crude, what happens to US CPI. So the bond markets will react, but there are too many other factors to which they will react. A word on IIP, we normally don't give much importance to that number, but this is painfully bad. At minus 0.8, the expectations were between 1.8 and 2%. We knew that the core sector had done badly. Those numbers were with us. Did you see the consumer non-durables and consumer durables number? Consumer non-durables is 10% contraction. Ties in with the fact that all the FMCG companies told us that they have done mid-single digit and low single digit. Something's really going wrong at the bottom of the pyramid. That's the message. Even July's IIP has been pulled down by 20 basis. Actually, yesterday's data is a bit more worry on growth rather than on inflation.
Oh, absolutely, Lata. Thanks very much for that. I mean, it's not a strange situation, but it is interesting.
Yeah, it's not a dire, but a little worse than expected.
And this is happening at a time, as you pointed out, this is bottom of the pyramid, right? There are 3 legs to the economy: the government sector, corporate sector, and retail. Government is doing just fine, tax collections, etc. You've got the corporate sector, which has never seen healthier balance sheets, but the retail segment, the consumer, especially at the bottom of the pyramid, as Lata pointed out, that is unmistakably, there is a bit of a slowdown, as managements have also highlighted. Thanks very much for that. We'll take a very quick break here. We'll come back. Aditya Suresh, Head of India Research and Strategy.
Welcome back. Well, the SGX Nifty suggesting a bit of a pullback, but let's focus on earnings and the start of earnings as well. We have Aditya Suresh, Head India Research and Strategy at Macquarie, who joins us. Hi, Aditya. Morning. Thanks so much for joining in. Well, what are you making of the start to earnings season? We have a few IT names that have come in there with their numbers. It's a mixed sort of reaction that we're getting. But what kind of earnings, growth are you factoring in, say, for this year? And do you see there's a bit of a downside risk to it?
Well, thank you, Nigel, and thank you for having me on the show. Just zooming out a bit and heading into this earnings season, one of the key themes to kind of think about is India is set to deliver about 16% EPS growth this year and then next year as well. So 2-year forward EPS CAGR of about 16%. Within this, if you kind of compare this with, say, emerging markets, the world, it's, say, +5%, +6%, right? So there is that big kind of growth outperformance message, which a lot of us are expecting to be reiterated through this earnings season. Into the results, one area where we're feeling comfortable is financials. The other point we've been making is that in terms of the cuts to margins which we're expecting in IT and consumer, that, in our opinion, is already in the base. So into this result season, and this is something which we don't typically speak about, which is that we're feeling far more comfortable with where the aggregate earnings expectations are. And plus 16% looks achievable. So far, I think IT is doing okay.
What about oil and gas, Suresh? This quarter, at least in terms of expectation, oil marketing companies are likely to post a big loss due to the marketing as well as inventory losses since retail pump prices were frozen. But there is that compensation close to about 22,000 crore rupees, which is going to be doled out. What have you made of the recent developments?
I think the oil marketing companies predicting quarterly earnings is impossible, right? So sure. So the last quarter, these companies reported these record losses. This quarter, perhaps, is a bit of reversal to that. That's kind of broadly what's in our expectations. But focusing on quarterly earnings for the oil marketing companies in an aggregate India sense, I don't think moves it too much.
No, but since they are going to be compensated now, does it make OMCs a buy now, a compelling buy?
We do have buys on these companies on valuations. I think it's tactical in nature to some of the points that you're making. I don't think these are fundamental kind of, for these to be fundamental buys on a long-term basis, we need far lower volatility in earnings.
Right. Aditya, you said 16% growth. Where are you at for 23 and 24 now in Nifty earnings?
At that 16%. So we're at about 16% for both fiscal 23 and fiscal 24 growth.
No, in terms of absolute numbers? Because, I mean, many have pulled down their growth estimates for 23 to about what? I think 840, 830, 840, 11, 12% growth. 24 consequently has also been brought lower. So just trying to understand.
So Prashant, we do this on an MSCI India basis, and on that basis, yes, we have kind of pulled down estimates of the past 2 quarters. But I guess the setup which I was trying to explain was that today at plus 16%, that looks far more achievable. 6 months back or 9 months back, the growth expectations which were built into numbers, that was probably a bit too high.
Aditya, do stay on. We want to just quickly turn the spotlight on the IT sector because both HCL Tech and Wipro reported their Q2 earnings yesterday. HCL Tech has met expectations in the second quarter. They raised the full-year growth guidance. Wipro's second quarter was also in line, but the company expects the growth in the third quarter to remain a bit modest. Listen in to both the managements and what they had to say yesterday.
Margin performance has significantly improved. We did very well. We posted an EBIT of 18%, which is in line with our desired recovery plan. It's a result of significant operational efficiency measures coming to fruition. We've got good billing rate improvements for all the higher-end services that we are delivering to our customers. We remain very positive of our near-term growth and the medium-term growth. This confidence is coming from the booking that we've had in the first half of this year and also the quality of pipeline that we have for the remainder of the year.
In a market condition where uncertainty exists, and I think it's true for most of the sectors across, Europe and America, we just felt the need to be cautiously optimistic. And we will continue to observe the evolution of the market. For now, the demand continues to be strong, and certainly, if we look at the volume of deals to close in Q3, we are also optimistic and positive about the fact that we can deliver another strong quarter in bookings.
Let's get in an expert as well. Sandeep Agarwal, the Executive Director, Institutional Equities at Nuvama Group, now joins in. Sandeep, morning, and thanks so much for joining in. We've seen some pretty sharp earnings downgrades on Wipro. You have brought down your EPS estimates by 8.4% for FY23. FY24 EPS estimates are lowered by 5.3%, and even FY25 earnings expectations have been brought down by 6%. Can you tell us where was the big miss, and what did you make of the management commentary?
No, so see, the earnings cuts are primarily led by cross-currency impact. There is huge appreciation of other currencies versus dollar. So while, we get some benefit on the INR, but most of the other currencies are hurting us very badly. And because of that, there is a change which we have done. Over and above that, we believe that Wipro's margin trajectory has changed a little bit. So this 5-7% cut which you are seeing is broadly a few basis point of margin cut, which is resulting to a bigger number in terms of EPS cut, which is a mixture of, again, cross-currency impact and also the trajectory change which has happened. Wipro has 2 months of wage hike which will be taken into account, which leads to higher cut for this year, because we were expecting a little better margins and it has come slightly lower than what we have anticipated. But having said so, we continue to believe that demand remains very strong in the industry and growth will remain strong going forward. Margins will recover from here for the sector as a whole because attrition has picked out and it will start cooling off substantially from here. So we maintain our positive stance on the sector as a whole.
Right.
Wipro Tech will grow little lower than the Infosys, TCS and HCL Tech within the pack.
Sandeep, cross-currency has impacted all the IT companies, but for HCL Tech and TCS, you've not lowered the EPS estimates to the same extent. The tweaks have just been about 0.5, 0.6% thereabout. Can you tell us how your margin estimates for Wipro have changed? What was it that you were earlier projecting and what is it now?
So see, you are right. In case of TCS and HCL Tech, what has happened, if you see, both the companies have delivered slightly better margin than what we have anticipated. So we did not have to take any cut in margins in the current quarter. While in case of Wipro, the margin estimates were almost 30-40 basis point, lower than our estimate, and versus street also it was lower than, I think, 20 basis point. So because of that, we have to make this change. We were earlier building in a stronger recovery in margins around 16.5%. But now we are cut down that by 40-50 basis point, and because of that this change is happening. Other companies like, as you mentioned, TCS and HCL, they have been able to manage their margins through operational efficiency, their realization. If you see, HCL Tech has got almost 115 basis point of delta from pricing alone in the IT services piece. So there is little bit of divergence because of that.
Just one word on Wipro. You were earlier anticipating margins of 16.5% by when? And now what is it? What's the number?
So we were expecting 16.5, 16.7 for next year, which 24. Is now cut by 30%. Yeah.
Okay. What about HCL Tech? HCL Tech has positively surprised on growth, and now HCL Tech services revenue is going to outpace all the peers, including Infosys, TCS, etc. And its valuations are also relatively cheaper. Is there a case for, if someone has to buy IT, money moving to HCL Tech, investors preferring HCL Tech because its growth is faster now compared to peers?
No, so see, always it has been the case that, HCL Tech is a late cycle play. So when the cycle begins, then, TCS and Infy always lead the performance, and then, followed by HCL Tech, because they have a very high concentration of IMS piece, which are transformational in nature and takes longer time to convert. If you see the simple logic to see Indian IT from an overall perspective is that in last 3.5 years, almost $550 billion of cloud has got sold, hyperscaler sales have happened. And to implement that, different companies have different number, but the minimum number should be $1.25 trillion over next 5 years to execute that, of which almost 70-80% has to be global sourcing. So we are talking about 700 billion, of which probably Indian IT should get 550 billion over next 5 years. So we are talking of $120 billion incremental revenue every year from implementation of this cloud piece alone. So I think that, the industry will do extremely well over next 4 or 5 years. And within that, HCL, because of its higher concentration of IMS, should do even better. That is the way we are projecting.
All right. Thanks very much, Sandeep. It's always a pleasure having you with us here. Detailed explanation on what's happening in that space. We'll see. I mean, HCL, out of the two, HCL numbers perhaps surprising more, and as Rima pointed out, potentially perhaps there is a bit of a move there. We'll wait and watch. Aditya Suresh, of course, is still with us. Aditya, thanks for waiting. Appreciate you holding on. So apart from, so you're constructive, right, with regards to earnings growth prospects, etc. My colleague Latha just outlined the industrial production numbers, growth numbers, right? These are monthly numbers. But there is a very pronounced and visible slowdown in the bottom of the pyramid, which is visible now. The consumer is not doing all that well, middle and lower end. How does that kind of feed in to your expectations and sector preferences going forward?
I think Latha's comments at the start actually summarized our sentiment quite well, and how we're reading the data as well. Because in terms of the consumer, I think there's a clear distinction to be drawn. The top end, the top, say, 20, 30 million, that slice is doing okay. And you can kind of look at this from the lens of whether it be credit card spending, debit card spending, all that stuff. That stuff is still up about 20% if you look at this versus 19. But if you look at broader consumer confidence in urban India, or if you look at the bottom of the pyramid and kind of the data coming out in rural, that's still an area where we're cautious. So all of Latha's comments at the start was something which we concur with. So being fairly selective and cautious here on whether it be staples or discretionary.
Okay, all right. Aditya, I request you to hold on. We're just slipping into a short break. When we come back, we'll get chatting with our technical expert.
Okay, welcome back. There's 9 minutes to go for the pre-open session. Sudarshan Sukhani and Mitesh Thakkar are with us with some trading ideas and the setup broadly. The SGX is indicating a mildly lower start after yesterday's 150-odd point up move. Gentlemen, good morning, both of you. Sudarshan, to you first. How are things looking this morning? If we do get that 30-40-odd point dip, should one do anything, or it's largely going to be quieter than usual given the big data point later today?
Good morning, Prashant. See, the markets are quite choppy. It's not a trend. So trending markets are easy to catch. Here, we see a dip, gap down, and then an intraday rally, sometimes a gap up and an intraday decline. So this is not a tradable market as of now. And with big data points, as you said, with big news coming in front of us, I do not think it's a good idea to enter into any trade today. Now, this is not going to last long. We have seen this period multiple times over many years. When markets become choppy or go into a trading range, they eventually break out on the upside or on the downside. So all we need is a little bit of patience. Today is one of those days of patience. Do nothing in the Nifty or the Bank Nifty.
Okay, all right. No trade there then for Sudarshan. Mitesh, what about you? How are you viewing both these indices? Yesterday we had a bit of a relief rally. Do you think we're good for more, or do you think we're likely to move back down to around the 16,800, 16,900 odd zone?
Yeah, Nathan, my sense is that I think the markets have been kind of consolidating, failing to get past 7300 on the upside, while we haven't had a decisive break below the 200 average at about 16,980, 950 zone. So I think we are still stuck in that range. Broadly, my bias is slightly on the negative side. I think eventually we'll break on the downside. That's a higher probability of an event. And once that happens, then I think 16,750, 800 is the minimum target. But I think logically 16,450, 500 zone should be tested. So in that sense, we have slightly negative outlook. Though I think till the breakdown happens, we are not aggressively going short in the markets, but we have some put option spreads. Having said that, I think trading is slightly more stock specific with banking and IT on the buy list. While I would say that we've been shorting the other areas in the markets.
Sudarshan, what would your trades be?
Well, individual trades are mainly biased on the short side today. Apollo Tyres is my only buying opportunity. The stock has been consolidating, has a relative strength, which means it's better than the Nifty. It doesn't mean it's much better, but at least it's better than the broad market. Buy with a stop under 265. Coromandel is an intraday short. The stock has been falling and making new lows regularly and consistently. Intraday short with a stop above 978. Dalmia Bharat is another intraday short. Look at the chart, same thing as Coromandel, making new lows. Even when the market was having those small rallies, it did not participate. Intraday short with a stop above 1532. And finally, Indigo, which has come in my shortlist earlier. It's a bear market for Indigo. It's an intraday short with a stop above 1779.
Okay, Mitesh, what about you? What are the trading ideas for today in terms of stocks?
Yeah. So I have a mix of buy and sell calls, 2 buys and 2 sells. The first call is a buy on City Union Bank with a stop at 180 for targets of 195, and IDFC Limited is a buy with a stop at 74 for targets of 80. And on the selling side is Asian Paints, keep a stop at 32.75, look for targets of 31.80. And Havells is a sell with a stop at 12.90 for targets of 12.30.
Thank you very much, all of you, for taking us through that. Need to get into a very short break. We'll come back with the pre-opening rates. We'll also connect with Kalpati S. Suresh of Veranda Learning Solutions as the company acquired J.K.